What becomes unavoidable, once the numbers are examined closely, is that the UK's private house building model has not merely slowed. It has slipped into a position where large parts of its existing asset base no longer function as productive capital. The issue is not a sudden collapse in demand, nor a temporary spike in interest rates. It is that land, the central input around which the entire industry is organized, was priced for an economic world that no longer exists. Between roughly 2015 and 2022, the UK experienced a historically unusual alignment of conditions. Interest rates were near zero, mortgage credit expanded steadily, and house prices rose faster than wages almost every year. In that environment, land was not simply a factor of production. It became a financial asset whose value appeared to rise independently of what was eventually built on it. Major listed builders responded in a predictable way. They accumulated large land banks, often years ahead of development, financed by cheap debt and justified by forward-looking price assumptions. Company reports from Persimmon, Taylor Wimpey, Barrett Developments, and others during this period repeatedly framed land holdings as a store of future value. Investors rewarded this behavior. Higher land banks signal future output, future revenue, and future profit. The system depended on one core assumption: that the final selling price of homes would comfortably exceed both build costs and the price paid for land. That assumption has now fractured. Since 2022, the cost side of the equation has shifted sharply. Office for National Statistics data show construction input costs rising far faster than general inflation through the post-pandemic period, driven by materials, energy, and labor. At the same time, mortgage rates rose rapidly as the Bank of England tightened policy, reducing effective purchasing power across much of the buyer market. House prices have not collapsed nationally, but they have stalled or fallen in real terms, particularly outside the strongest regions. The result is a margin squeeze that operates mechanically. Land bought at peak prices embeds an expectation about future sales values. When build costs rise and achievable sale prices fall below those expectations, profitability does not decline gradually. It disappears. This is why, over the past 2 years, large builders have announced multi-billion-pound land value write-downs. These are not discretionary decisions. Accounting standards require firms to recognize when assets can no longer generate the returns once assumed. However, writing down land does not restore viability. It merely acknowledges that losses already exist. The more important consequence lies in day-to-day behavior. When expected margins fall to low single digits or turn negative, building becomes a risk-amplifying activity rather than a profit-generating one. A delayed sale, a cost overrun, or a local price adjustment is enough to turn a site from marginal to loss-making. This is why headline figures showing hundreds of thousands of consented homes coexist with falling housing starts. ONS data confirm that private sector starts have declined materially, even as population growth and household formation continue. The constraint is not planning permission in isolation. It is that builders are rationally refusing to convert impaired land into realized losses. Holding land, even at a reduced book value, is often less damaging than building homes that cannot be sold at a price that covers total costs. This behavior is sometimes framed politically as land banking, but that term misses the underlying mechanism. What is happening is closer to capital preservation under adverse conditions. Firms are choosing inactivity over value destruction. That choice becomes even more pronounced once finance is considered. Development lending in the UK relies heavily on land as collateral. As land values are reassessed, banks reprice risk. Bank of England credit condition surveys already show tightening lending standards for construction and real estate. Several major lenders have reduced exposure to development finance altogether, particularly for smaller builders. Without reliable collateral, the flow of credit that keeps the industry functioning slows dramatically. The distributional impact is immediate. Large listed firms can pause activity, absorb impairments over time, and rely on diversified funding. Small and medium-sized builders cannot. Insolvency service data show construction remaining among the sectors with the highest failure rates. Each firm that exits takes skilled teams, supplier relationships, and local capacity with it. This capacity does not reappear quickly, even if market conditions improve. Labor shortages deepen constraint. The UK construction workforce is aging. Apprenticeship starts have declined since the late 2010s, and net migration changes following Brexit reduce the availability of EU-born skilled workers. Industry bodies and the Resolution Foundation have repeatedly highlighted shortages in key trades. Emigration of experienced workers to countries offering higher pay and more stable pipelines further erodes domestic capacity. The system is losing skills faster than it is replacing them. Even external demand that once helped support stretched developments has weakened. For much of the previous decade, foreign capital, including buyers linked to East Asian property markets, absorbed units that domestic demand alone might not have sustained. The prolonged downturn in China's property sector has reduced that source of demand. This does not collapse the UK market, but it removes an important margin of support at precisely the wrong moment. What emerges is not a dramatic crash, but a reinforcing loop. High land costs and rising build costs suppress supply. Reduced supply supports prices, but not enough to restore margins. Tight credit and labor shortages prevent rapid adjustment. Firms survive, but output falls. Housing need continues to rise, while delivery capacity quietly contracts. This is the structural context in which the UK's private house building industry now operates. The problem is not confidence. It is that the basic economic equation underpinning speculative house building has stopped balancing, and once that happens, the consequences extend far beyond developers themselves, into finance, labor markets, and ultimately the broader economy. Transition. As these pressures accumulate, the exposure does not remain confined to firms directly involved. It begins to surface in places that were never meant to bear construction risk at all, particularly within long-term savings and institutional balance sheets, where housing has come to be treated as a stable, low-volatility asset. That exposure matters because housing in the UK has not simply been a consumer good or a social necessity. Over the past 2 decades, it has been woven deeply into the country's system of long-term savings and institutional investment. Pension funds, insurers, and asset managers have increasingly treated residential property and the companies that develop it as a stable anchor within diversified portfolios. The assumption was not that housing was risk-free, but that its risks were slow-moving, geographically diversified, and ultimately underwritten by chronic undersupply. As the private house building model weakens, that assumption becomes harder to sustain. UK pension funds are exposed to the housing sector through multiple channels. The most visible is listed equity. Major builders are widely held across pension schemes, index funds, and active portfolios. Less visible, but often more significant, is exposure through corporate bonds, property funds, joint ventures, and direct land holdings. In recent years, many schemes increase allocations to so-called real assets in search of yield and inflation protection. Residential property, particularly new build development and build to rent, fitted neatly into that narrative. The difficulty is that much of this exposure is predicated on forward cash flows that assume a functioning development pipeline. When land values are impaired and building activity slows, those cash flows become less reliable. Equity valuations can adjust quickly, but private assets adjust slowly, often with a lag of several years. This creates a period in which reported values appear stable even as underlying economics deteriorate. What this produces is not an immediate crisis for pensions, but a gradual erosion of expected returns. Defined benefit schemes already under pressure from demographic aging and past underfunding are particularly sensitive to this. Defined contribution savers are exposed more diffusely, through market performance rather than explicit write-downs, but the effect is no less real. Lower long-term returns mean higher contribution requirements or reduced retirement income, though the link is rarely visible to individual savers. This slow transmission of stress is why the system can feel calm even as it weakens. Losses are absorbed incrementally, spread across time and institutions. Accounting frameworks allow impairments to be recognized gradually. Firms continue operating, servicing debt, and reporting positive cash flow even as their underlying capacity to expand shrinks. This is a context in which analysts increasingly refer to parts of the sector as zombie-like. Not because collapse is imminent, but because survival depends on stasis rather than growth. The housing supply consequences are profound. The UK already builds fewer homes than most official assessments of need. The Office for Budget Responsibility has repeatedly downgraded its medium-term projections for housing completions, citing weak private sector delivery and policy uncertainty. Local authorities, constrained by borrowing rules and capacity, have not filled the gap. Housing associations face higher financing costs and competing demands on capital. The result is a widening structural shortfall. Importantly, this is not evenly distributed. Areas with the strongest labor markets and highest incomes continue to attract investment, while weaker regions see development stall entirely. This reinforces regional inequality. Places that most need regeneration struggle to attract viable schemes, while already strong markets capture what limited capacity remains. The feedback loop between housing supply, labor mobility, and regional productivity tightens. Tenure patterns shift as well. As for sale development becomes riskier, capital increasingly favors rental models backed by large institutions with long investment horizons. Build-to-rent can add supply, but it does not expand ownership. Over time, this changes who housing is built for. Younger cohorts face higher barriers to entry, not just because prices are high, but because fewer homes are ever offered for sale at accessible price points. Ownership becomes concentrated among older households and institutional landlords. The social consequences accumulate slowly. High housing costs reduce disposable income, suppress consumption, and limit household resilience. Labor market flexibility declines as workers find it harder to move to where jobs are. Family formation is delayed, with knock-on effect for demographics and long-term growth. None of these outcomes arrive suddenly. They emerge through years of constrained choice. Policy, in this environment, faces hard constraints. Planning reform alone cannot restore viability if the underlying cost-price equation remains broken. Subsidies risk inflating land values further unless carefully designed. Direct public building requires capacity that has been allowed to atrophy. Each intervention runs into the legacy of past decisions: reliance on private developers to deliver a public good, dependence on rising asset prices to fund supply, and chronic underinvestment in skills. What becomes clear is that the current situation is not a cyclical dip awaiting recovery, but a structural adjustment playing out across multiple systems at once. Housing, finance, labor, and demographics are interacting in ways that reinforce inertia rather than correction. The danger is not collapse, but entrenchment, a slow normalization of underdelivery and exclusion. If this trajectory continues, the private house-building industry does not vanish, but it changes character. Fewer firms, fewer starts, more concentration, and less responsiveness to need. Housing supply remains persistently below requirements, and the burden shifts elsewhere, onto renters, onto public services, onto younger generations whose economic lives are shaped by scarcity they did not create. That question, what replaces the existing model, cannot be answered by looking only at housing policy in isolation. It sits at the intersection of fiscal capacity, political incentives, and the long-term structure of the UK economy. The private house-building system that emerged after the 1980s was never designed to operate without rising land values. Once that condition disappears, the state is left with choices avoided for decades: either accept chronic undersupply as a permanent feature, or intervene directly in ways that reshape risk, ownership, and return. Historically, the UK solved housing shortages through large-scale public and quasi-public building. That capacity was dismantled gradually, not replaced. Local authorities lost not just funding, but institutional memory and delivery expertise. Today, even where there is political will to build more, delivery is constrained by skills shortages, procurement complexity, and fragmented land ownership. Recreating that capability is not a short-term project. It requires sustained investment over many years, with returns measured in social stability rather than immediate financial yield. In the absence of such a shift, capital will continue to flow toward the parts of housing that still offer predictable returns. That increasingly means rental housing owned by large institutional investors, pension funds, sovereign wealth funds, and global asset managers. These actors can accept lower annual yields because they value stability and inflation-linked income. From a financing perspective, this makes sense. From a societal perspective, it marks a decisive move away from mass home ownership as a dominant tenure. This transition is already visible. Industry data show a growing share of new supply coming through build-to-rent schemes, particularly in urban centers. While these developments add units, they also change the distribution of risk and reward. Renters bear long-term cost exposure, while asset appreciation accrues to institutions. Over time, this alters wealth accumulation patterns across generations. Older cohorts, who bought when prices were lower relative to income, retain housing wealth. Younger cohorts face a future of higher lifetime housing costs with limited access to ownership. The macroeconomic implications are subtle but significant. High housing costs act as a tax on labor, reducing real wages and discouraging mobility. Firms struggle to attract workers in high-cost areas unless wages rise, which feeds into inflationary pressure. Productivity growth suffers as talent mismatches persist. These are not headline-grabbing crises, but they weigh steadily on growth potential. The OECD has repeatedly highlighted housing affordability as a drag on UK productivity and labor market efficiency. There is also a fiscal dimension. As home ownership falls, political pressure increases for rent support, housing benefit, and social housing provision. These costs rise even as the tax base becomes more dependent on asset-owning households and institutions. The state ends up subsidizing outcomes it no longer controls, paying to manage scarcity rather than eliminate it. This is an expensive equilibrium, but a stable one, which is why it can persist. None of this implies inevitability in the strongest sense. Policy choices still matter, but the range of viable options narrows as capacity erodes. Skills pipelines cannot be rebuilt overnight. Land acquired at inflated prices cannot be magically repriced without losses being realized somewhere in the system. Every year of underbuilding increases the stock gap that future supply must overcome. What the data point toward is a prolonged period of adjustment rather than resolution. Housing supply remains constrained. Ownership becomes more selective. The private sector builds where margins allow, not where need is greatest. Public intervention increases at the margins, but does not fundamentally alter delivery. The system settles into a lower output, higher rent equilibrium that feels normal precisely because it emerges gradually. For individuals living through it, the experience is often described in personal terms. Harder to save, harder to move, harder to plan. But structurally, these are predictable outcomes of an economy that tied a basic necessity to asset inflation and then lost the conditions that sustain that inflation. The strain does not express itself through a single breaking point. It diffuses across time, cohorts, and institutions. After examining the data, what stands out most is not the scale of any one failure, but the coherence of the pattern. Land values, finance, labor, and demographics are all pulling in the same direction. Each constraint reinforces the others. This is why incremental fixes struggle to gain traction. The system is not misfiring. It is operating according to incentives that no longer align with social outcomes. If the UK enters the 2030s with a housing system increasingly dominated by rental tenure, constrained supply, and institutional ownership, it will not be because of sudden collapse, but because the existing model quietly ran out of room to function. The challenge then will not be how to restart a stalled engine, but how to redesign a vehicle built for a different road, one where housing is treated less as a speculative asset and more as long-term infrastructure. And that is a political and economic decision that cannot be deferred indefinitely, because the longer adjustment is left adrift, the more unevenly its costs are distributed, and the harder it becomes to reverse course once a generation has been priced permanently out.